an interesting take from Cointelegraph. It's basically, the title is Bitcoin miners should pay costs in depreciating currency. Taking advantage of the increasingly divergent fundamentals of Bitcoin and fiat currency could be a way out for struggling miners. Bitcoin mining firms should hold their mined Bitcoin and use it as collateral for fiat-denominated loans to pay operating expenses instead of selling Bitcoin and losing the upside of an asset that miners expect to surge in price, according to John Glover, Chief Investment Officer at Bitcoin lending firm LED. There we go. Now, I'm going to tell you guys this. There were a lot of people trying to do this at the height of the 2021 cycle. You may have heard of like Core Scientific, for example. They were doing this. They were taking loans out. A lot of them were taking loans out on the cost of the actual hardware. Still, that hardware is directly related to the price of Bitcoin in general. And what they were doing was basically buying a bunch of the hardware, taking the loans out on the hardware to continue to pay for the operating costs, and then continuing to hold the Bitcoin. Well, obviously, that ended up in a lot of bankruptcies at the end of the day. And like I've always said, cash flow is king. And if you can't cash flow, you know, especially these large mining operations, at the end of the day, you're going to go under. Now, obviously, when you're playing with that amount of money, there's a ton of different ways to get bailed out. Core Scientific was able to bail out of that. A lot of other companies were able to get out of that sort of issue. But it did have a massive impact. It basically made the entire cryptocurrency market crash even harder than I say it would have without that happening, right? And a key example is looking at previous halving cycles. And if you look at like 2016 to 2018, what we saw was, you know, a return to previous all-time highs for the price of Bitcoin, but not much below that. A little bit below that, yeah, but not much. Not to the extent where we saw, you know, the previous all-time high in 2018 was like 21,000 Bitcoin. If we move forward to 2021 or 2022 and 3, when we move into the bear market, we fell significantly below that $21,000 mark, down to like that $14,000 price point. And I think that was a direct cause, or basically these loan options were a direct cause for that, right? Because you ended up in a position where not only did the price of Bitcoin went down to a point to where they had to liquidate their Bitcoin to cover costs, to basically finish out the bankruptcies, all that sort of stuff. And that all of that money from lenders, all of that Bitcoin that lenders were getting, was just immediately getting sold off to cover basically the loans that were unfeasible to pay back because of the market taking a downturn. So I don't think that we're going to go through this article, and they're obviously putting it in a positive light. I still don't think that I don't think it's a good idea. Now, there has been some success if you're just talking about purchasing Bitcoin, using the valuation of that company that's holding Bitcoin to then get loans to buy more Bitcoin. Strategy has implemented this to success. There has been successful stories from this, but not all of them are successful, right? There were a lot of bankruptcies for that. And if this does implode, it's going to have a larger negative effect on an already suppressed halving cycle in moving into basically what would be considered a traditional halving cycle bear market, right? And we could go significantly below previous all-time highs from 2021 of that, you know, $60,000 to $70,000 mark. We could go way below that in a bear market this time around if everybody ends up capitulating at the end of the day because they have way too many loans out on the Bitcoin that they have in holdings, and the price of Bitcoin isn't meeting that valuation of the loan, right? And this gets into all of the trading problems I have with like the trading on. So I'll go back to this. Bitcoin was meant to be peer-to-peer without the interference of a third party, and the things that we're doing to bastardize that, like leveraging trading and futures, all of these types of things require a third party to basically essentially bet against, and you are gambling at the end of the day. And I think that's having a negative impact on the entire industry as a whole. And I don't think practices like these are good or in the proper nature of Bitcoin at the end of the day. In an interview with Cointelegraph, Clever said that holding on to the Bitcoin carries several benefits, including price appreciation, tax deferment, and the potential to make extra revenue by lending out Bitcoin held in corporate treasuries. So he said, quote, "If you are mining, you are generating all this Bitcoin. You understand the thesis behind Bitcoin and why it is likely to continue to appreciate in the future. You do not want to sell any of your Bitcoin." This debt-based approach is similar to companies like Strategy, which issue corporate debt and equity to finance Bitcoin acquisition and profit from the diverging fundamentals of Bitcoin and the fiat currencies the corporate capital raises are denominated in. Bitcoin-backed loans could be a valuable lifeline for miners struggling in the highly competitive industry, which is facing increased pressure due to the ongoing trade tensions brought on by the Trump administration's protection trade policies and macroeconomic uncertainty. Now, I would say that if you are a miner, it is probably more well advised to take out loans against your Bitcoin than against your hardware. Reason being is hardware, ASICs in this particular case for Bitcoin, which are application-specific integrated circuits, only work for Bitcoin, right? And because of that, there's no external purpose for those in general, unless you're going to go to Bitcoin Cash or, Digibyte, excuse me, something along those lines, a Blue D, right? But because of that, because the mining equipment technology is improving significantly year over year, the depreciation of your miners or the hardware to mine the Bitcoin are not only facing the depreciation of the value of the asset that they're mining, but also the depreciation of the unit itself. And so you kind of have a double whammy there when you look into it. That being said, if you got good cash flow as a miner, you can really also utilize that depreciation on the hardware as, to help with those taxes in general. So there is that benefit for the hardware. Resaleability, though, from a large mining firm perspective on, massive amounts of ASICs that can only mine one thing, not as good as you would think, right? Whereas like GPU mining in general, the thought was, you could sell those off to gamers at the end of the day. And I think that's like GPUs still, frankly, have held better, a better value than ASICs over, the previous cycle, even though there's not a lot of GPU mining. And as Sky is asking, is GPU mining dead? We're going to react to a video here in a little bit, and I'll give my thoughts on that. But as of right now, like I said, I don't think taking out loans against Bitcoin would be more well advised than taking out loans against the hardware that is mining the Bitcoin. I hope you enjoyed this clip from the Crypto Mining Show. If you would like to see more from this particular episode, take a look up here. Don't forget to also subscribe to the channel. And if you want to support me directly, you can go to sonofatech.locals.com and become a member. Thanks for watching, and I will see you next Tuesday.